Here's a shocking statistic that'll make you rethink everything you know about money. The average person who starts investing at age 25 will have over $1 million more at retirement than someone who waits until 35, just 10 years. That's the difference between financial freedom and working until you die. Hey everybody, it's Billy here. If you're looking for a simple, step-by-step system to start investing and actually build real wealth, even if you've never bought a single stock before, then you are in the right place. I'm about to reveal the exact process anyone can follow to start growing their money without needing thousands of pounds to begin, without a finance degree, and without spending hours glued to stock charts every day. I get it. Investing can feel intimidating and overwhelming, especially when there's so much confusing jargon and so many horror stories about people losing everything. But don't worry, because today I'm breaking down Investment for Beginners, a full how to invest guide that covers everything from your very first dollar invested to building a portfolio that works for you on autopilot and stay until the end. Because I'm going to share the one beginner mistake that costs people more money than almost anything else, and it's probably not what you think. Quick disclaimer. Hi, it's your friend Billy. Please note that this channel is for education and entertainment only. I'm not a financial advisor. This is not financial advice. Talk to a real professional before you do anything with your actual money. I'm serious. Don't be that person. All right, back to the video. Let's get into it. But here's what nobody tells you about investing. It's not about having perfect timing or picking the next Amazon stock. It's about understanding a simple system that anyone can master, regardless of how much money you're starting with. I spent 12 years and I watched thousands of people make the same costly mistakes over and over again. Today, I'm going to share everything you need to know to start investing successfully, even if you've never bought a single stock in your life. We'll cover the exact steps to get started, the biggest traps to avoid, and the simple strategies that actually work in 2026. Before we dive in, let me be clear about something. This isn't about get-rich-quick schemes or day trading your way to millions. This is about building real, sustainable wealth that will compound over decades. If you're looking for gambling advice, this isn't for you. But if you want to learn how money actually grows and how you can put it to work for your future self, then stick around, because this could be the most valuable 20 minutes you spend this year. The first thing you need to understand about investing is why it even works in the first place. When you invest money, you're essentially lending it to companies or governments in exchange for a piece of their future profits. Think about it like this. When you buy a share of Apple stock, you're buying a tiny piece of that company. When Apple makes money, you make money. When Apple grows, your investment grows with it. But here's where most beginners get confused. They think investing is about predicting which companies will succeed and which will fail. That's not investing. That's speculation. Real investing is about participating in the overall growth of the economy. And here's the beautiful part. The global economy has been growing for centuries and shows no signs of stopping. Over the past 100 years, the stock market has averaged about 10% annual returns. That means if you invested $10,000 and left it alone for 30 years, it would grow to over $170,000. That's the power of compound interest, and it's the reason why starting early is so incredibly important. Now let's talk about the different types of investments you can make. The most common and arguably most important is stocks. When you buy stock, you're buying ownership in a company. Stocks have historically provided the highest returns over long periods, but they also come with more volatility. Your investment value will go up and down, sometimes dramatically, but over time the trend has been consistently upward. Then you have bonds, which are basically loans you give to companies or governments. They pay you interest over time and are generally considered safer than stocks, but they also provide lower returns. Bonds are great for adding stability to your portfolio, especially as you get closer to retirement. Real estate is another major asset class. You can invest directly by buying property or indirectly through real estate investment trusts, which are companies that own and operate income-producing real estate. Real estate has been a solid long-term investment, though it requires more capital and involvement than stocks and bonds. There are also alternative investments like commodities, precious metals, and even cryptocurrency. These can play a role in a diversified portfolio, but they shouldn't be your primary focus when you're starting out. Here's what's crucial to understand. You don't need to become an expert in all of these. In fact, trying to be an expert in everything is one of the biggest mistakes beginners make. Instead, you want to focus on building a simple, diversified portfolio that gives you exposure to all the major asset classes without requiring you to make complex decisions. This brings us to one of the most important concepts in investing: diversification. Never put all your eggs in one basket. This isn't just advice, it's a mathematical principle that can dramatically reduce your risk without sacrificing returns. When you diversify properly, you're spreading your money across different types of investments, different industries, and even different countries. The easiest way to achieve diversification is through index funds and exchange-traded funds, or ETFs. These are collections of stocks or bonds that you can buy with a single purchase. For example, an S&P 500 index fund gives you ownership in 500 of the largest companies in America. Instead of trying to pick individual winners, you're betting on the success of American capitalism as a whole. The beauty of index funds is that they're automatically diversified. They have very low fees and they require almost no maintenance from you. You can buy them, set up automatic investments, and then basically forget about them while they grow over time. Now let's get practical. How much money do you need to start investing? The good news is, not much. Many brokerages now offer commission-free stock trading and have no minimum account balances. You can literally start investing with whatever money you have available right now. But before you invest a single dollar, you need to make sure your financial foundation is solid. First, pay off any high-interest debt. If you have credit card debt charging 18% interest, paying that off is guaranteed to give you an 18% return on your money. No investment can match that kind of guaranteed return. Second, build an emergency fund with 3 to 6 months of living expenses. This money should be in a high-yield savings account, not invested. It's your safety net for unexpected expenses or job loss. Only after you've handled these basics should you start investing. Once you're ready to invest, here's the simple process to get started. First, choose a reputable brokerage firm. Some popular options include Fidelity, Schwab, Vanguard, and newer platforms like Robinhood or Webull. They all offer commission-free stock trading, but pay attention to their fund selection and fees. Next, decide what type of account to open. For most beginners, I recommend starting with a Roth IRA. This is a retirement account where you contribute money that's already been taxed, but then all your future growth and withdrawals in retirement are tax-free. The contribution limit for 2026 is $6,500 per year, or $7,500 if you're over 50. If you want to invest more than the IRA limit, or if you want access to your money before retirement, you can also open a regular taxable investment account. There are no contribution limits, but you'll pay taxes on any gains when you sell. Once your account is set up, it's time to choose your investments. For beginners, I strongly recommend starting with broad market index funds. A simple 3-fund portfolio might include a total stock market index fund, an international stock index fund, and a bond index fund. This gives you exposure to thousands of companies across the globe with just 3 investments. As you get more comfortable and learn more about investing, you can gradually add complexity if you want to. But honestly, many successful investors stick with simple index fund portfolios their entire lives. There's no shame in keeping it simple. One of the most powerful strategies you can use is dollar cost averaging. Instead of trying to time the market, you invest the same amount of money at regular intervals, regardless of what the market is doing. This helps smooth out the ups and downs and ensures you're buying more shares when prices are low and fewer when prices are high. Most brokerages allow you to set up automatic investments so you can have money transferred from your bank account and invested in your chosen funds automatically every month. This takes the emotion and guesswork out of investing and helps ensure you stay consistent. Speaking of emotions, let's talk about the psychological side of investing. This is where most people fail. The stock market will go down sometimes. In fact, it goes down about 1 out of every 4 years on average. When it does, your account balance will decrease, and that can be scary. The key is to remember that market downturns are temporary, but market growth is permanent. Every major crash in history has been followed by new all-time highs. If you panic and sell when the market is down, you'll lock in your losses and miss the recovery. This is why having a long-term perspective is so important. If you're investing money you might need in the next 5 years, you probably shouldn't put it in stocks. But if you're investing for goals that are 10, 20, or 30 years away, short-term market movements are just noise. Let me share a story that illustrates this perfectly. During the 2008 financial crisis, the stock market lost over 50% of its value. Many people panicked and sold everything, locking in massive losses. But those who stayed invested and continued buying during the downturn saw incredible returns as the market recovered. By 2012, the market had not only recovered, but reached new all-time highs. The lesson here is that time in the market beats timing the market every single time. The sooner you start investing and the longer you stay invested, the more wealth you'll build. Now let's talk about some common mistakes that can derail your investing success. The first is trying to pick individual stocks. Unless you have extensive knowledge about a particular company and industry, you're essentially gambling. Even professional fund managers who have teams of analysts and years of experience struggle to consistently beat the market. Another mistake is checking your account balance too frequently. When you check your investments daily, you're more likely to make emotional decisions based on short-term movements. Set up your automatic investments and then check your progress quarterly or even annually. Don't try to time the market by waiting for the perfect moment to invest. The best time to plant a tree was 20 years ago. The second best time is today. The same principle applies to investing. Every day you wait is a day of potential growth you're missing out on. Also, avoid the temptation to chase hot investment trends. By the time something becomes a popular investment trend, it's often too late to benefit from it. Stick to your simple, diversified strategy and ignore the noise. One mistake I see constantly is not taking advantage of employer retirement benefits. If your company offers a 401k match, that's free money. Always contribute enough to get the full match before investing anywhere else. It's an instant 100% return on your money. As your investing knowledge grows, you might want to explore more advanced strategies. You could add sector-specific funds to bet on particular industries like technology or healthcare. You might consider international emerging market funds for higher growth potential. Some investors add real estate investment trusts or commodity funds for additional diversification. But remember, complexity doesn't equal better returns. Some of the most successful investors in the world use incredibly simple strategies. Warren Buffett, one of the greatest investors of all time, has repeatedly said that most people should just buy low-cost index funds and hold them forever. Let's talk about taxes and how they impact your investing. In tax-advantaged accounts like IRAs and 401ks, you don't need to worry about taxes until you withdraw the money. But in regular taxable accounts, you'll pay taxes on dividends and capital gains. One strategy to minimize taxes is to hold your investments for at least 1 year before selling. Long-term capital gains rates are much lower than short-term rates. Also, consider tax loss harvesting, where you sell investments that have lost value to offset gains from other investments. As you build wealth, it becomes increasingly important to rebalance your portfolio periodically. This means selling some of your winners and buying more of your losers to maintain your target allocation. It sounds counterintuitive, but it's actually a form of systematic buying low and selling high. Now let's address some specific situations. If you're in your 20s or 30s, you can afford to take more risk because you have decades for your investments to recover from any downturns. A portfolio that's 80 to 90% stocks makes sense for young investors. If you're in your 40s or 50s, you might want to start shifting toward a more conservative allocation, perhaps 60 to 70% stocks, and the rest in bonds. This provides some stability as you approach retirement while still allowing for growth. For those nearing or in retirement, capital preservation becomes more important than growth. A 50-50 split between stocks and bonds might be appropriate, though this depends on your specific situation and risk tolerance. What about investing for your children? A 529 education savings plan offers tax advantages for education expenses. You can also open custodial investment accounts for minors, giving them a head start on building wealth. Now, before we continue, and if you're serious about putting these lessons learned into action, I've put together something special just for you. Over at financescoops.com, you'll find our free money reset ebook. It's the perfect companion to everything we covered today, and it'll help you build your personalized money plan step by step. Use the first link in the description below to get your copy. It's completely free. Technology has made investing easier than ever before. Robo-advisors can automatically manage your portfolio based on your goals and risk tolerance. Apps like Acorns round up your purchases and invest the spare change. But don't let technology replace understanding the basics of investing. One thing that hasn't changed despite all the technological advances is the importance of continuous learning. Read books about investing, follow reputable financial news sources, and consider taking courses to deepen your understanding. The more you know, the better decisions you'll make. However, be careful about information overload. There's an endless stream of market predictions, stock picks, and investment advice available online. Most of it is worthless or even harmful. Stick to proven principles and ignore the noise. Let's talk about inflation and how it affects your investments. Inflation is the gradual increase in prices over time, and it erodes the purchasing power of your money. This is why keeping all your money in a savings account is actually risky. Even if your account balance stays the same, your money becomes worth less over time. Stocks have historically been one of the best hedges against inflation. Companies can raise their prices to keep up with inflation, which helps protect your purchasing power. Real estate is another good inflation hedge, as property values and rents tend to rise with inflation. As we move into 2026, there are some specific considerations for new investors. Interest rates are at historically high levels compared to the past decade, which makes bonds more attractive than they've been in years. However, this also means that companies with a lot of debt might struggle more than in the past. The rise of artificial intelligence and automation is creating both opportunities and risks in the market. While these technologies are driving growth in some sectors, they're also disrupting traditional industries. This is another reason why broad diversification is so important. Geopolitical tensions around the world are creating more volatility in markets. International diversification helps manage this risk, but it's also important to be prepared for more ups and downs than we've seen in recent years. Climate change and environmental concerns are increasingly important factors in investing. Environmental, social, and governance investing, or ESG, allows you to align your investments with your values while potentially reducing long-term risks. Here's what I want you to do after watching this video. First, if you haven't already, pay off high-interest debt and build an emergency fund. Then choose a reputable brokerage and open either a Roth IRA or a taxable investment account. Start with simple, broad market index funds and set up automatic monthly investments. Most importantly, start now. Even if you can only invest $50 a month, that's better than waiting until you have more money. Time is your most valuable asset in investing, and every month you delay is compound growth you're giving up. The path to building wealth through investing isn't complicated, but it does require patience, discipline, and consistency. You don't need to be a genius or have insider information. You just need to understand these basic principles and stick to them over time. Remember, investing is not about getting rich overnight. It's about gradually building wealth that will give you options and security in the future, whether that's retiring comfortably, buying a home, starting a business, or just having the peace of mind that comes with financial security. The most successful investors are often the most boring ones. They buy broadly diversified index funds, invest regularly regardless of market conditions, and then ignore their accounts for years at a time. It's not glamorous, but it works. If you found this guide helpful, make sure to subscribe and hit that notification bell so you don't miss more videos breaking down investing, personal finance, and wealth building strategies in a way that actually makes sense. Drop a comment below letting me know what your biggest investing question is, and I'll try to address it in a future video. And remember, the best investment you can make is in your own financial education. The more you understand about money and investing, the better equipped you'll be to build the life you want. That's your complete investing starter guide. Now check out this video on screen. It's the perfect next step after what we just covered. I'll catch you there. Stay smart with your money.